Hello and welcome to Moneycontrol special on managing market turns. My guest today is Kenneth Andrade, founder and CIO of Old Bridge Capital. Kenneth, thank you so much for joining me on this discussion today. So the first question really is, over your entire career, you've definitely seen more than two market cycles. How is this market cycle really different from all the cycles that you have seen in the past?
Hey, we've all been down that path multiple times before, and it's always the same. You had 2 good years, so obviously you'll have a consolidating market or a correcting market. So I don't think there are too many differences in this market cycle compared to the rest. Of course, there are a lot of events that have led up to this correction, very different from the previous ones. And in a normal case, I mean, a decadal corrections usually lead to market changes. So I think what you should need to watch out for is if the market leadership is changing, and if the market leadership is changing, you've got to be sensitive about it and adapt your portfolios accordingly. But otherwise, it's basically a textbook correction that you're going through.
So Kenneth, do you think what is playing out now is an intermittent correction and we will see a continuation of this bull run? Or do you think we will see a steep cut that won't get resolved too quickly?
It always gets resolved. So every time markets come down, they do go up, and when they go up, they come down. But I don't think that's going to be any different this time around. Yes, the timing of this is anyone's guess. But for over a medium term structure, I think you need to be constructive when you're talking about equities and that asset class, right? And it's got more legs this time than probably in the last couple of cycles where it was where the pricing was right, but the upsides were not really predictable. But this time around, I think there is not so much of stress, whether it's at an economic level or whether it is at a corporate level. There is definitely stress as far as inflation is going, and some part of demand will get affected. It hasn't gotten affected. If it hasn't gotten affected, it will get affected. We've got to cross that hump.
So are you suggesting that it is only on the valuation side that we have excesses and there is no reason to worry about the economic growth as such?
There will be an economic growth slowdown. So I think the focus here is nominal GDP versus real GDP growth. And nominal GDP growth will surprise us, and not because real GDP growth is actually going up. And that's where the concern is, and that's also probably where the opportunity set lies. And if you look at it, value-wise, a lot of product pricing exists, though inflation is taking away a lot of profitability. So businesses are doing well on a headline number or on a sales number. Profit growth is relatively muted. Now that profit growth is going to another part of the economy, which has been profitless for the last decade. So from a 5 year on a five, I mean, if you take a consolidated 5 year profitability versus the previous 5 year profitability, I think the structure of profit will continue to climb. Just the participants in that pool of profit will change. And when I did answer your previous question on a market correction, I think you need to sensitize yourself that profitability is moving from one extreme of the economy to the other.
So are you talking about this shift from consumption to investment-led growth? Because that is what was really the huge change in the last few years, that because of your balance sheet problems, because of your banking rot in the banking sector, growth really didn't happen in that place. And that is what the market was also expecting will reverse sometime last year, where the economy-related stocks, PSUs, all of them sort of surged up. Are you talking about continuation of that trend?
So I just linked it a little differently, right? You said that there was, in the last decade, and it happened, right? There was stress on corporate balance sheet, there was stress in the banking system, so banks didn't invest in the corporate world. Now, this is exactly why capacity didn't come up. Okay, so demand has always been growing. Now, demand usually grows by about 5% or in line with GDP. But when there was a supply constraint, and what you had right now was a shock. One is because of a pandemic, and second is because of a minor war that is taking place. you had a supply shock. And when that supply shocks happen, yeah, things get a little out of hand. So you talk about a supply chain collapsing, and that essentially is what happening. So India has not put up that capacity. The US has not put up the capacity. A large part of the globe depended on each other for a lot of basic materials, including energy, and that's creating the chaos which is there in the current environment. So it's a supply shock that has happened, and that supply shock is showing up in this level of price rise, simply because a large part of the world has not been investing in 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 the basic economy. The investment economy was to come back, uh, but now I think it's on a much more firm footing than it ever was.
So you don't see any threat to that? I mean, this whole interest rate cycle reversing. And even now, if you really look at capacities across the board, it's not really that we are peak capacities at all. Do you see any demand destruction on the contrary because of interest rate cycle? For example, real estate is one classic case where we were hoping that the cycle will continue. In fact, there will be a reversal of the cycle, demand will come back and all of that. Do you see any threats lurking around there?
I think you have to give this a little time for things to play out. There's an interest rate reversal for sure. There is also a reset on inflation expectations for sure. And you've had a one-time reset on inflation or on pricing on the ground. So energy prices have doubled. Commodity prices are up almost the same. To say that they will repeat this performance in the next year, 2, 3, 4, that is not going to happen. So let's look at an environment where pricing remains elevated. Okay, and you've already got a high base this year.
Right.
And next year, you will manage inflation expectations completely. So we have to navigate this year. You've got a high base that will come in, and next year the numbers won't look as dramatic as they look this year. So interest rates are high; they will continue to remain elevated, but that also will show up in inflation across a lot of assets that are there on the ground, a lot of earning capacity that is there on the ground. So you might just take a pause this year, but overall, I am not so. I'm pretty constructive in the next year, including for industries like the real estate marketplace.
Okay, so PSU pack, how do you see that? Because again, it was riding on the same story. One, of course, was the disinvestment story, but largely it was also backed by the optimism around the economy. Do you see that as a safe haven or a good space to hide in, even in case there is some kind of moderation in valuation in the next few months?
So we're not. I mean, I look at those companies as dividend deal businesses, and beyond a certain point in time, then they lose their attractiveness if you start valuing them on a price earning multiple or any other metrics that are there. So till they are there on a dividend metrics, it looks okay. But I don't ever believe that these companies will become growth companies ever. There's no state-owned enterprise globally that's become a growth business.
Right. So from a one-year perspective, do you take those deals, or is this a market where you would still want to play the long term?
No, I don't think. I mean, we don't. Or at least from a construct of portfolios, we can't flip flop. I mean, if it's going to be a safe market, we're not going to go into cash as going to stock tomorrow. Executing that kind of a framework is virtually impossible on a relatively larger size portfolio. So that's not the way we tend to do it. But if you are an individual investor, these places might look like they're a safe haven, but the longer term opportunity is much larger, longer, and probably be much more rewarding than we've seen it in the past.
More rewarding than we have seen in the past. So, Kenneth, your best hunting ground is really mid caps and small caps. It won't be misplaced to say that you're the king of mid caps and small caps in India. But Tell me now that space has really seen a lot of carnage over the last few weeks. How do you size up that opportunity now? Are we really at levels that we can start nibbling back or buying from a 2-3 year perspective? Or do you think a lot of froth still needs to get unwound before it becomes a good opportunity to buy or becomes screaming buys?
The correction's been nice. It's been also fairly deep. And I was a buyer at the top also, and I continue to remain. Uh, uh, I find these valuations in some of the businesses, or should I say, the opportunity in some of these businesses fairly large and scalable. Look, our favorite hunting ground is in places where capacities have not been set up. Okay, where there's an underinvestment of capacity, and the macro environment looks good. Now, when companies don't do well, it's usually a period of time when the marketplace ignores them. And that's a space that we need to capture in most of our portfolios.
And what are those opportunities? Where do you really see underinvestment?
So I think the investment cycle is kicked off. I mean, we've been long-term shareholders in the agricultural sector. We've been long-term shareholders in some of the businesses which are in manufacturing. Now, manufacturing is fairly diversified, including agro processors that are there, right? But from a commodity perspective, from an engineering perspective, I think there are fairly interesting opportunities in any of those businesses that are there. Export-bound businesses and pharmaceuticals is the other opportunity which is sitting out there. And there is some element of technology also which is correcting into this cycle, which I think is fairly attractive. And finally, obviously a domestic piece, but at least mathematically, the opportunity in real estate is really falling into place.
So is that when you talk about the agri space, I know you've been bullish on that segment for quite some time. Do you see anything other than fertilizer and sugar, or what kind of stocks are you really talking about?
Oh, there's plenty. I mean, there is a lot of agricultural processors out there right now. We got a couple of businesses in corn processing. We have obviously got a very large suite of businesses in sugar. I mean, this is not something that we own, but we own a couple of names across some of these categories that I'm talking about. Fertilizers for sure, agricultural machinery, where India is about, I think we're already the largest users of tractors in the world in number wise. Then so it cuts across the chain. There's a seed company or two that's listed, but it's fairly large. But when you put these numbers, it's a fairly unorganized business. There are a lot of companies that are there in the private domain and not so much in the public domain. And that's what interests us, because availability of capital to a lot of these companies are fairly low. And the larger get more dominant as the days go by.
Right.
Also, this underinvestment has created opportunities, plus price inflation of the end product creates an opportunity wherein if you follow the money in the entire cycle, or the profitability matrix in the entire cycle, it gets reinvested into something, right? And that's a situation that we like for now. What's driving agriculture in India, at least in the near term, and it's a very near-term environment that we're looking at, is when the industrial use of the product. Okay, ethanol is getting used in India in fuel. In Indonesia, Malaysia, and countries that are there in palm oil, it's getting used in biodiesel, and that's creating shortages of edible oil in India, or it's taking sugar out of the global market.
Right.
Okay, and that's where the industrial use of the product comes through. So if I just put a number to it, India does 400 crore liters of ethanol. Okay, that's on last calendar year, last financial year. We're running up capacity to about 1,500 crore liters by 2025. Okay, and this is in public domain. So if you have a 4x increase in output, and this is ethanol, you need a 4x increase in input.
Sure. So many of these stocks that you are talking about are certainly not cheap, right, Kenneth?
Yes, in an environment like this, you won't get them cheap.
So even in these valuations, you would think they are good buys?
I am just saying that there's an opportunity which is sitting out there. The market pace is expanding by 4x. There is profitability coming into that value chain. You'll have to make sure you're pretty much well positioned out there, because market will create excesses on the top, or valuations will create excesses on the top. So none of these companies are as cheap as they were probably 2 years back. But the opportunity on the other side does exist, and you have to time your exits pretty much uh, appropriately in most of these businesses.
So Kenneth, that is the typical problem that you see in the market today, right? If you look at a lot of segment, including specialty chemicals, there is a huge growth runway that you do see in several segments. But the problem really is the market tends to front end a lot of that growth, and therefore the price opportunities become very limited. So my question to you is, where is it that you right now see those price opportunities getting created because we are going through a correction?
So market valuations are fair, you won't get them cheap. One industry which has not done anything for a fairly long period of time, it basically bounced back during a COVID period, but it's been flattish, is pharmaceuticals. The other one that again that's fairly large is real estate. The kind of capital that industry could access, even in a rising interest rate environment, is far. I mean, the cost of capital is far lower than they've ever seen in the history of that industry, and that and also the leverage that industry can see, it could probably be at a very different level. So that's two near-term or two industries where in the near term there is reasonable amount of value. If I could not say this, in a couple of these names there are deep value. Uh, the the other ones are almost midway through a valuation cycle, but nowhere close to a growth cycle, which is effectively in engineering, commodities, and some part of these agricultural businesses that are there. Okay, they're midway to the cycle. So I'm not, you're never going to get a whole market which is, unless you step back into 2020, which is at the bottom end of pricing. You're never going to get that happen. Not in a corrective mode. So you will have to measure as to what is, or you'll have to size up the opportunity that is there and pay the right price for it. The right price is different for different investors.
Right. So you said we are never going to see the March 2020 kind of markets, right? So if you were to just map the fear and greed factor in the market today, which year would you correlate current markets to? In a sense, where exactly in the cycle are we really in?
I think it'll be somewhere between 2005, 6, 7. May not be 7, but 2005, 6, or probably even in 2004, 15, 16. So we're somewhere around that.
Okay, so that mid-cycle, so you still have substantial amount of upside from a 2-3 year perspective. Is that correct?
Oh, I mean, on a 2-3 year, 5 year basis and a 10 year basis, markets always tend to go higher, but the participants change. I would never rule the probability out that we could be fairly large by the end of 2030. This is quite an interesting cycle as far as Indian manufacturing, Indian exports are concerned.
Kenneth, one of the points you made is that the leaders will and are changing. Where are you seeing these new leaders really emerge? Because if you really see, it's the commodities, energy stocks, those are the spaces where really you saw a lot of underinvestment. And those stocks have done well. Even in this drop, they haven't dropped as much. Do you see the up move really continue there?
Okay, let me give you another context to it all. Of course, you can decide how much you want to pay for it. Okay, but if you size up an opportunity, I would say, one of India's largest steel companies made a profitability in 1 quarter. Okay, higher than the annual profitability of India's largest FMCG business, pure FMCG business, in 1 quarter, right? And it trades at 1/3 of the market capitalization. Now, I mean, we know which companies we're talking about. Now,
Right.
the thing is that you may choose to agree with me or disagree with me, because one is a cyclical business and the other one people tend to believe is a structural business.
Right.
I've invested in FMCGs or I used to be an FMCG analyst in 1997 to 2001 too, right? And that was a cyclical down cycle for FMCGs.
Right.
Right? And those companies never made you money from 2001 to 2009.
Correct.
Right? But that was a cyclical down cycle for those companies. They grew at 1%, or some of them didn't even grow. There was a huge amount of M&As till capacity came out of that cycle. Okay. And that at that period of time, you've had all the cyclicals hit price earning multiples, which we've never seen before. So
Correct.
India's largest construction and contractor moved from 8 times earnings to 60 times earnings because it ended up being a growth cycle, right? So
Right.
this was last in to grow in 2008, beginning of 2008. There were some real estate companies that listed at that point in time. In 2007, I think there was one listing that was there. In 2007, there were a number of listings, and a lot of them, or all of them, have not crossed their all-time highs in market caps, or they've done so only very recently, right? So now you can put the profitability in context. So I started off by saying one steel company has made more profit in a quarter than India's largest FMCG business. You've already seen a shift in profitability. Okay, the shift in profitability within the economy or within corporate India has already happened. Now we'll wait to see whether the price earning multiples or the re-rating, or so-called re-rating, or the market capitalizations go from one extreme of an economy to the other, or one extreme of markets to the other. But that's a patience wait. I tend to believe that will happen. So it's going to be low earnings growth, or it'll be earnings growth in some of these companies driven by volumes, and there'll be a significant shift in the way you price some of these structural businesses that are there.
Sure.
When you get a 3% return on your fixed deposits post tax, 3% or 4%, okay, at least in our methodology of valuations, I find valuing business over 25 to 30 times earnings a little different. Basically, an earnings yield can't be significantly higher than 4%, or under 4%, not over 4%, under 4%.
Correct.
And that's where our disconnect with some of the valuation parameters that are showing up exist.
But Kenneth, that is exactly what is getting challenged now with this reversal in the cycle, right? The very fact that we think inflation is not a transient problem, it is a more longer term issue. And therefore, and anyway, we are at the rock bottom of interest rates, whether it is in India or globally. So that is what is getting really challenged. So obviously, when the rates go from 3%, 4% fixed deposit to 7%, 8%, maybe even higher than that, then the whole matrix should also change considerably, isn't it?
Yes. So none of us have been, or at least I haven't, in the last 30 years of my of investing or looking at markets in the first phase. I have no experience of this cycle. Okay, so we could only build a scenario, do scenario building on how these things will evolve from a macro point of view, right? And that's also challenging. But to be on the safer side, it's easier to buy valuations. Because simplistically, if interest rates go up, valuations have to fall. And you're safer off with valuations being on your side, because the valuations have to correct from the higher price earning multiple businesses, and then they come down. So on the safer side, you're better off being being in places where valuation is on your side, and this is the way we're building it out. Now, building a scenario on a macro context, what happens if inflation comes back and if interest rates rise? Look, the world's too used to low interest rates, right? And to tend to believe that interest rates will rise at a rate of 15% per year, I don't think that's going to be sustainable, because then you're driving too much of the world into bankruptcy. So you'll have a nominal growth in inflation. Like I said, next year inflation numbers will get readjusted because of the higher base. And then a lot of regulators will take their foot off the accelerator in terms of hiking interest rates. And you will have elevated pricing. Okay, and interest rates will follow that that pattern. But the interesting part of a cycle like this is a significant part of all the capital that is being created is going back to government balance sheets. And I think that's what we need to continue to look towards for continuation of a growth cycle. What I mean by this is the decade that went by, okay, it was the consumer balance sheets that drove a growth cycle. Because you had purchasing power, and you had companies at the consumer facing companies that had the pricing power. Today, if you look at it, consumer companies don't seem to have the pricing power because a lot of inflation is eating into their margins, and at the other extreme, a lot of inflation is taking away or transferring capital from the consumer and the saver back into the economy or back to the governments. So even the consumers do not have purchasing power. Okay. So I think this decade is all about being, or from our construct, it's all about looking at government balance sheets, how much they strengthen, and how much cash flows from government balance sheets will go back into the economy. So government-facing businesses across the world will probably be very large hunting grounds for corporates who want to grow into this cycle, which goes back to what the government priorities are.
And on the FMCG pack itself, so do you see another 4 or 5 years or a long spell of underperformance? Because two things: one, valuations for all of these consumer companies, the valuations are on the higher side. Second, in the last few years, if you see, a lot of profit growth has really been squeezed in. So in terms of efficiency and margins, you've really hit a peak, and now that is probably set to reverse with inflation and no levers to really leverage on. So do you think they are going to be underperformers for a long spell now?
So if you ask me the same question in 2008 about the infrastructure businesses, I would not be able to answer it. Okay, and if you ask me the same question to the consumer businesses, I don't know if I'll be putting out the right answer. I think you've got to differentiate between a good company and a good stock. Good companies probably don't always make good stocks, right? And that's where we are.
Why do you say that? Because all these, I mean, if you talk about Asian Paints, Pidilites, all these established good companies, even in the recent times, I mean, they have been good stocks because they all got re-rated in the last 5-6 years. And again, good companies have got derated also in the past. I mean, right from Infosys, if you look at, they were not good stocks at that time. So right now, is it not possible to make up your mind on whether these are good stocks or not? Like even in 2008, you could have called many of the infrastructure plays bad stocks, isn't it?
So you answered the question also there. I mean, TCS, Infi, all have had their down cycles. But that didn't make them bad companies. They just went through a turn in the industry, and that's exactly what we are answering.
Right.
What we're answering with the FMCG pack is, will profitability in that industry continue to grow at the same pace it has done in the past? Okay, if your answer is affirmative, go ahead. If you see inflationary pressures and lack of pricing power and lack of demand, then obviously it'll take time for them to consolidate, acquire businesses, grow adjacencies to their business, increase their footprint, and wait for India's per capita income to move from $2,000 to $3,000. And in this industry's profitability will only grow if the user base income base actually goes up. So I think we've probably hit a cusp in the market cycle or in the economy where your per capita income's already hit a number, okay, beyond which a significant growth in profitability for a lot of companies addressing that per capita will stall for a while.
Right.
So which is, I say, good companies you don't necessarily need to sell them, but yes, of course, there are a lot of their returns incrementally will be back-ended. They will definitely be there, but they will be back-ended.
Sure. Would you say the same thing about some of the finance companies, for example, Bajaj Finance? Of course, valuation is again out of whack, but anybody focused on consumer finance, do you see them being underperformers over the next 2-3 years?
I wouldn't want to stick my neck out saying that they'll be underperformers because I've been proven wrong so many times before on a couple of these names. So I'll just stall that question there. But yes, we don't find comfort on some part of the valuation metrics in some of these companies, and we will pause. But our argument on the macro side continues to remain that personal balance sheets will be under a challenge. Discretionary spends will come down. Income levels will not grow in line with inflation or be below inflation. And that makes it a very challenging environment. It makes it a very challenging environment, but it's a very opportunistic environment for some of these companies because a lot of these companies will go out and will acquire reasonably large market share at virtually no cost because the tail end of the market the tail end of competition is actually collapsing.
So urban consumption again is one of the themes that you had talked about in the past as an opportunity and a hunting ground right now. How does that basket really look, and what exactly are you seeing there?
So the thing with urban consumption is we're very specific on a particular geography and a particular industry, which is basically IT, and it's a fairly large employment driver in the southern part of India. It's also probably a space, and if the broader trends or the broader industry trends are right, where wage growth will be ahead of inflation, which means that consumption patterns in that part of the world are going to be significantly better. Which is also a bias in the real estate side, which is more South India based and Western India based, which is financial services and IT in that part of the world. Though east of India is also surprisingly doing well because of the mining income that's coming in. But that's the basket of opportunities that we see as far as urban consumption is concerned. It's basically the top bracket of income earners in the country, which where the incomes are not going to get impacted as much as rural India is or the rest of India is. See, the difference between urban India and rural India is while agricultural produce will go up, or agricultural produce in quantum will go up as well as in pricing will go up. Close to between 60 and 70% of their consumption basket is food. That is a large part of India. So inflation is not really beneficial for that part of the world. In urban India, the number is significantly lower. It's almost 30 to 40% that goes into the food basket. And so, which is why we think, the previous decade, it was all India did well in terms of consumption. Here, it will be a little bit more muted. And it will be very centric to a couple of industries, which are doing much better in terms of volumes plus pricing, and that is technology, some part of financial services, and the employment it generates under that. So that's a macro context to it.
Sure. And in terms of avoidable sectors and stocks, what is a very clear no-no for you in today's market?
I can't say there's something very no to us. Uh, so again, I mean, without doubt, we like to pay a reasonable price for a business on the ground. So unless the category of companies or businesses which are fairly rich, we stay away in spite of them doing well, and they might continue to do well. It's not a hunting ground for us because we built up with the discipline that we need to buy a company where valuations are low, because when growth kicks in into, or when the cycle kicks in for these companies, you have an expansion of earnings and you have an expansion of the multiples.
Right.
So you have two levers that work for you, and which is how you compound the capital, or this is how we tend to believe that we compound capital. And that is what has worked for us till now, or for me as an investor has worked for now, and hopefully into this the balanced part of my career, it should play out uh, very similar.
Sure. Kenneth, there are right now three pressure points in the market depending on which segment of the market you're really focusing on. High valuation, margin pressure, potential demand destruction. Those are really the pain points. So when you go out with your shopping list and you want to buy on dips, how do you decide which dip to buy and which one to pass?
No, I don't think, I mean, in most of the dips that I've seen, if you buy into the same, in the near term, you actually make money. So when you're getting a dip in the market cycle like this, you're better off staying with the businesses that you know rather than getting into businesses that you don't. So this is not a learning cycle. So you've already learned it to the peak of the last cycle. You just buy the same names over and over again, and that's my discipline.
So in a good company, even if you know that there is a earnings disappointment coming up and it's going to linger around for a few quarters, would you still buy the dip?
But quarters is not really material. I mean, you have to structurally tend to believe that the demand for the business, its pricing power is completely destroyed, because there's no such thing as it goes off in a quarter and comes back again.
Hmm.
There are enough parameters out there to believe that these companies will come back.
Hmm.
And that's what you need to convince yourself about. So on the down cycle, you have to get back to brass tacks and figure out if there is structural decline in the parameters of the business, or it's just a cyclical change. And once you've been able to define the two, cyclical or structural, if it's cyclical, keep buying the same. But if you're seeing a structural decline, so a structural decline is when you lose pricing environment, whether it's for the product or whether it's because of the environment, then it's going to take some time before those companies come back.
Sure. You know, how do you look at the auto space? I mean, since you're talking about cyclical, structural, that is one place which is going through a huge structural shift. But that's also the space where you see maximum value in terms of valuation. So how do you see that as a space?
Well, autos is a fairly broad context, but um, two-wheelers, too much happening. Okay, you've got a change in technology that's happening. You've got fragmentation of the business, and you've got the premium end of the market actually falling apart. So there's way too much happening out there. I rather let it decide which direction it wants to go, or let which direction it wants to go as far as the technology is concerned before taking a call on something like this, because the price war is for real. Plus, then there are supply chain issues. The new guys are not being able to get scale in. So there's a lot of things, lots of things happening in the two-wheeler market. The commercial vehicle market, it's a very different space there, and that's one exception that I make when we say that in the automotive market, the lender might have the maximum amount of pricing power out there, and we will go with a lender in that business, a financial services business, a company in that business, rather than try and second guess which which part of the market can pass on the inflation to the end user.
Hmm.
Because let's put it this way. There is a CV manufacturer that's there, or if you're buying a CV today, You've got a 20% growth and a 30% growth in a new vehicle market. One is because raw materials are gone up. Second, there's a shift in technology.
Right.
From a lender's perspective, for the same asset, he gets a 30% inflation on the asset book itself. Okay, so vehicle to vehicle, today you're getting a 30% higher opportunity to lend. So inflation creates its own opportunities that are there. And that goes for any corporate lender. The marketplace currently is seeing asset prices being bid up or actually going up, which effectively is giving growth to corporate lenders. So I wouldn't be out of place to say this, but a large part of corporate growth or the lending book growth that is coming through because of financing inventory on the ground or working capital on the ground, which is largely inflationary led. And we're seeing that with every line item of companies that are declaring results.
Sure.
So on the automotive space, just to put it simplify, we'll go with a lender out there, but and if you have to buy an automotive company, we will go more with the CV cycle, which has not done anything for a very long period of time, than
Understood.
with the consumer-led franchise.
And four-wheelers? I mean passenger cars?
It's going the same way as the two-wheeler market, but there I think there's an established there are a couple of companies that have taken the lead in
Right.
but you still have to get scale back in. But I think once you establish leadership as far as technology and as far as is concerned, these companies usually that one particular company or these companies usually gain market shares.
Sure, sure. So Kenneth, overall, if you were to describe your sentiment right now, would be bullish or
I'm fairly
cautious?
constructive. So it depends upon your time frame. If you're asking me in the end of 2023, I have no problem at all. If you're asking me end of calendar 2022, I have no clue. But I'd be very constructive. I mean, we effectively buy the dips with the same companies that we have. I wouldn't want to time the market, but you're getting it almost 20% cheaper than what you've seen it at its all-time high. In some cases, your stocks are down by almost 30% to 50%, which is much cheaper than what you saw them in a couple of months back. So I wouldn't worry getting into 2023.
But in 22, you wouldn't hazard a guess with whether we will cross the all-time high for this year, or we could sort of
No, we
brace.
will cross the all-time high this year. Since you're asking me to guess, I can guess, right? So we won't cross the all-time high this year.
No, I mean, would you bet more on markets going higher or lower this year?
I will be very comfortable if market ends the year at where we are.
That is your best bet.
I will be very happy.
Okay. And tell me, over the last 2 decades, if you could just pick out 2-3 most important investment lessons that you've learned out of your mistakes, your biggest mistakes, and what were the lessons you learned?
Okay. I mean, very clearly the one that I remember very well, which got us out of a lot of trouble in 2008, was the last stock you buy ends up being your biggest mistake. So it's always last in, first out, because in our format of investing, the last company we bought at the peak of the cycle was trying to look for value. And you created all the mistakes at that point, because in a market which offers no value and you're looking for value, you buy the wrong company. It happened in 2 cycles with me. So that sense it will happen in the 3rd cycle also. Don't look for value where there exists none. So that's one big takeaway that I did. Second is always watch for market leadership. Right. In 2000, I tended to believe that once IT collapses, that's the only one that will come back because of the large opportunity, because of our discipline, skill set, and the ability of our skill set and the population, and we are low cost, that this would be one of the best sectors to invest in. And we had a cyclical recovery of the entire investment piece.
Yeah.
So that was one of my biggest learning lessons of 2000, which fortunately we didn't repeat in 2008. We were, bypassed the investment bubble that was there in 2008-9. Of course, we did correct because everything corrects with it, but we sidestepped that completely. And this time around also, we don't have too much of financials, and we don't have too much of lending businesses. I should correct myself, and we do not have too much of consumer consumer facing businesses, because one, valuations were not attractive, and secondly, the macros now are shifting, have shifted quite dramatically, and somewhere in line with what our arguments have been, that high valuations don't necessarily need to be in continuation and perpetuity, and we've seen that multiple times.
Sure.
So that's our two bits about. That's my two bits about my investing lessons through the last three cycles that I've been through. The
Sure.
last one, or the one that we are in, I still have to establish whether we'll come out on the right side. But so far, the going's been pretty okay.
Sure. Is there anything that really worries you about this market in terms of what could go wrong?
Oh, everything does, because we don't know tomorrow. If I knew tomorrow, I wouldn't worry, but you don't know tomorrow. So everything can go wrong. I mean, there's an event sitting up there. There is polarization of capital into the top end of corporate India, as well as within the population itself. We don't know how the social fabric of the world economy in an inflationary environment like this will work. We haven't been through an investment cycle where we've seen interest rates go up. Yeah, but the US has been through a cycle where interest rates moved up, and you had the junk bond crisis, which was a bubble
Yeah.
economy, right?
Yeah.
So
Yeah.
higher interest rates mean lower markets. It actually worked the other way around
Hmm.
when uh, uh, in, in that particular cycle with the US. So those are things that you will learn with experience.
Sure. Anything, so is cash a strategy for you at all, or there is, you're constantly on the buying side?
Cash is never a strategy for anyone.
No, why do you say that? Because it is a good protection strategy, right?
Mhm. What? I mean, if I'm 15% cash, I still have to worry about 85%. 15% is not going to move the needle. I've done this. I've been there. I've done that. I've had 25% cash and 75% threw me off guard completely.
Hmm.
So your focus necessarily needs to be on what you've invested in, rather than worrying about the tail end of the portfolio, right? If 75% is what I've invested in and 25% is cash, 25% is not going to determine my future. It's the 75% that this is going to determine my future. So I worry about that part of it all.
No, that of course you have to protect your 75%. Would you not agree that that 25% cash, if you are nervous, one, you protect, and second, that also becomes opportunistic capital available for you to deploy at lower levels, the same stocks that you perhaps place your faith in, right?
Surely, I mean, it works well when we say it the way it is. But in practical experience, I honestly, in the last 15 years of investing, it it has not been material. It it takes out the volatility in the portfolio, but in terms of returns, it hasn't been material.
Why is that? It is because of our inability to time the market perfectly. Is that the
Obviously,
reason?
obviously. I mean, time, sizing, at the bottom end, when markets are making a dip, you don't get the volumes that you want in the stock price that you want. So obviously, a lot of things play a role in that.
Would you say it could be a different story for retail investors? Because as an institution, like you said, both buying and selling can become a difficult thing with higher volumes. But for a retail guy who can get in and out without worrying about the liquidity issue in a stock, would you think cash will be a good strategy?
Of course, I don't doubt it will be, if it's pretty well used. If you can time it well, then obviously cash will eliminate volatility, give you an options to buy lower. It does everything that it's said to do.
Sure. Sure. Thank you so much, Kenneth. It was absolute delight talking to you today. Thank you so much.
Thank you very much.